After being one of the best performers in 2020, the electric vehicle (EV) industry added to these gains in 2021, although there was considerably more volatility. In 2021, the Crane Shares Electric Vehicle and Mobility ETF (KARS) was up 22%, which is slightly below the S&P 500's YTD gain of 25%. In comparison, CARS had an 80% gain in 2020 versus the S&P 500's gain of 16%. However, 2022 does bring with it some of industry headwinds. A major challenge will be the Fed's hawkish pivot and the increase in short-term rates, which leads to outflows in growth stocks. Another challenge for the industry is supply chain issues with shortages of key components leading to production below capacity. Many companies will also have to reconfigure their production and assembly to account for increased EVs as well as develop new supply chains. Of course, it's also possible that some new EV releases will fail to connect with the public and generate sufficient demand. Still, there are many reasons for the industry's outperformance and reasons to be bullish on its longer-term outlook. The major factor is that EV sales are expected to sharply increase over the next decade and eventually overtake gas-powered cars as the dominant form of transportation. This continues a trend that started last decade. According to the IEA, there were less than 100,000 EVs on the road around the world in 2010. In 2021, there were over 11 million EVs on the road. By 2030, it's expected that there will be close to 100 million. A new industry. This type of growth means there will be tremendous opportunities for companies in the EV market, which is why we've seen EV leaders like Tesla, TSLA, and NIO soar. These two companies are currently the leading EV companies, have a devoted and loyal following, and have already demonstrated the ability to produce and deliver thousands of cars every week. Another development is that many legacy auto companies are positioning themselves for this new reality, with the most notable examples being General Motors, GM, and Ford, who are investing heavily in EV production capacity and are unveiling an entirely new lineup over the next couple of years. Even tech companies are getting in on the game, as Apple, AAPL, is reportedly looking to launch its autonomous EV in the coming years. Baidu, Viju has partnered with Geely, to do the same. In addition to legacy car companies and deep-pocketed tech companies, several startups are attempting to compete as well, such as Rivian, Lucid Motors, LCID, Lordstown Motors, RIDE, Fisker, FSR, and Nikola, and KLA. Many of these companies' stock prices are quite high despite these companies having no revenue and no immediate path to profitability. For the most part, these companies are still mainly in the prototype phase, while a handful is spending to build their production facilities or partnering with other companies for manufacturing. This will certainly be challenging in an environment with inflation and supply chain constraints. How they handle this expensive and complicated task will ultimately determine the fate of these companies. Accelerating EV adoption. According to Bloomberg, 5.6 million EVs were sold in 2020, and it projects that 30 million will be sold in 2030. The major impetus behind this growth is the falling cost and improving the performance of these cars. Other factors driving demand are rising gas prices and the improving performance of EVs. Already, many EVs are faster and more efficient than cars with internal combustion engines, ICE. Additionally, EV ranges are continually improving. Currently, most EVs have a 200-mile range, which is enough for 80% of households. However, there remain some challenges such as a limited number of charging stations, cold weather adversely impacting battery performance, and the amount of time it takes to charge EV batteries. However, like any new technology, these challenges are steadily being overcome. The next generation of EVs is expected to have 400-mile ranges. Charging stations are being rapidly built to meet this demand. Additionally, battery technology is being improved to increase charging times. Due to these improvements, EVs are expected to reach a crossover point within the next 5 years, at which point they will be cheaper with more power and range than gas-powered vehicles. Additionally, as production increases, costs will further decline on a per-unit basis due to economies of scale and network effects. EVs will eventually be cheaper to produce than gas-powered vehicles, with the most expensive component being batteries. Battery costs are also declining at a precipitous rate, and they will retain some residual value even after the car stops working. Government support. One of the reasons that the EV stocks added to their gains in the early parts of 2021 was Democrats winning control of the presidency, House of Representatives, and the Senate. This raised hopes that President Biden would be able to pass the measures that he had campaigned upon, like an expansion of the public charging network, increased subsidies for EV purchases, and tax credits for R&D. However, this has proven to be more difficult than anticipated given the tight margins in Congress, which give inordinate power to more fiscally conservative members. Thus, there was some money allocated for EVs in the infrastructure bill. $7.5 billion is allocated for EV charging infrastructure, with another $5 billion allocated for the purchase of low and no emission buses. Another $65 billion is allocated towards clean energy generation. The bill also includes $110 billion to upgrade roads, bridges and other infrastructure which benefits all types of vehicles. While the fate of the Build Back Better bill remains uncertain, it's even more generous in terms of EV policy. Most notably, the bill includes an increase in the tax credit to $12,500 from $7,500. The subsidies are more generous for companies manufacturing in the U.S. and with a union workforce. There was some hope that the bill would be passed along with the infrastructure bill. These hopes have faded as Senator Joe Manchin remains opposed due to his concerns about inflation. There remains the possibility that a smaller version of the BBB bill could be passed in 2022 as negotiations in the Senate continue. According to Morgan Stanley, the passage of the BBB bill would likely result in an additional 7 million EVs on the road by 2030. Chinese market. Currently, China is the largest market for EVs in the world. In large part, this is a reflection of government policy which is looking to reduce emissions to improve the environment. As a result, the Chinese government has offered a variety of incentives, including rebates, tax credits, and quicker approval times for vehicle registration. On the supply side, the Chinese government has directly invested in several EV companies and made low-interest loans to others. Also, the government sees having domestic EV makers as being important for strategic reasons, including employment. It's also created standards for the manufacturing and production of batteries that ensure they are swappable between different cars. This reduces any wasted investment if a company goes under. The government is also investing significant sums in charging infrastructure. These efforts have yielded some success. NIO, Spang, XPEV, and Li Auto, Li sales are growing, and the companies have already attained multi-billion-dollar valuations. They are even expected to start selling cars in foreign markets in the coming years. Their stocks are listed on U.S. exchanges and have skyrocketed over the last year. While these are the early leaders, there are close to 500 EV startups in China that are still in the product development phase. Adjacent opportunities. For people who want to invest in the EV industry, the most straightforward way to participate in the industry's growth is through buying stocks of companies making and selling EVs. However, a risk is that as the market matures, the competition will intensify, and some EV companies won't survive. To avoid this risk, investors may choose to diversify with a broad EV ETF, like Crane Shares Electric Vehicle and Mobility ETF, KARS, or the Global X Autonomous and Electric Vehicle ETF, DRIV. Another option is to invest in companies that are helping to develop the requisite infrastructure for EVs, such as the charging station stocks. Similar to gas stations today, EVs will require a distributed network of charging stations. This will require a significant upfront investment, but it would pay dividends in the future as more EVs are on the road. However, a lack of charging infrastructure would stymie the industry's growth. Some of the companies developing the technology for charging infrastructure are Blink Charging, BLNK, and Beam Global, BEM. An additional adjacent opportunity is to invest in companies focused on battery technology. Batteries are the heaviest and most expensive parts of EVs. Some EV makers are choosing to build their batteries, such as Tesla, TSLA, while others are outsourcing to companies like QuantumScape, QS. While there's less certainty about which EV company will emerge as the winner, demand for better batteries will certainly increase as the EV market grows. Investing in battery companies presents the same type of challenges as investing in EVs. However, investors can be confident that the commodities used as inputs to manufacture batteries, such as lithium, nickel, and cobalt, will see increased demand regardless of which battery company performs the best. Some of the leading companies that mine these metals are Albemarle, ALB, FMC, Rio Tinto, RIO, and Vale, VALE. Thank you for watching this video. We appreciate your continued support. For more daily news, please subscribe to our channel. This is Economics Empire, and we'll see you in the next one.